Hello, traders. FX Speculator here. Today is Wednesday. It is January 28th. So, hello. How's everybody doing today? Hopefully, fairly good. Pretty big day ahead of us today, as everybody probably knows. So, today is FOMC interest rate news. Federal funds rate is coming out this evening. Well, for me, it's this evening. It might be this afternoon if you're in the United States. Interest rate is currently 3.75, and they do not plan on lowering it. Now, when the market is surprised, right? So, if the market really is surprised by the news, that's when you're potentially going to get a big move in the market. So, if they decide not to lower interest rates, if they decide to keep interest rates as they are, which currently is 3.75. If they do not lower interest rates, then very likely this is not going to be a big giant move in the market. To me, it kind of seems like a lot of this scheduled news, which normally moves the market, is actually not what's been moving the market lately. Obviously, the geopolitics that's going on in the world right now has been moving the markets more than anything, in my opinion. I mean, obviously, the news on the news calendar is very likely to move the market. I'm just saying that there's probably a pretty good chance that the market is more concerned about what's going on with other more important scenarios right now. But anyways, like I said, we got the interest rate news coming out in about 30 minutes. I already have I'm not sure if it's PAL or not. I think it's PAL, but it might not be PAL. But I have the speech queued up for after. I'm not really sure if Powell's the one that's going to be talking or if it's somebody else going to be talking. Normally it is Powell, but I know Powell is done pretty soon. His 10-year term is about over, so I'm not really sure if it's him or not. We'll find out, I guess, in about 30 minutes. Now, the press conference is always kind of the more important event. At 7:30, which is this is UK time, by the way. I don't live in the UK. I live in Europe, but I am in the same time zone as the UK. So anyways, at 7:30 my time, which is 30 minutes after the news release, there's a press conference that usually lasts about 45 minutes. And whether or not that is, depending on what they say at the press conference, has a lot to do on what the market's going to do, how people perceive that, the next time, which is, I think, 6 weeks from now, what they're going to do with interest rates. I'm sure that Trump would like to continue to lower interest rates, but you got to be a little bit careful with these things, definitely. So we're going to watch the press conference together. Right now, we're going to go through all the dollar pairs. We're going to spend the next 26 minutes going through all the dollar pairs, especially the US dollar index. And we'll look at all the dollar pairs, including gold, and prepare ourselves for the news, see if we can figure out what the news is potentially going to do. And then the half an hour between 7 and 7:30 is when I'll take requests. I'll look at anything, I'll look at crypto, I'll look at any forex pairs, individual stocks, indices, indexes, commodities. I don't really care. You can have me look at whatever you want. Just put it in the chats on YouTube. I'll be more than happy to check out basically anything. So yeah, we'll do that, and then at 7:30 we'll watch the press conference together, see if there's any hints in there. A lot of the times during the press conference is when the market actually starts to settle in a direction. Many times what happens at these news events, which actually the last couple of times it didn't really do that, but a lot of the times at the news event it'll make a big move right at the news, and then the half an hour in between the news and the press conference it'll kind of slow down. A lot of the times it comes all the way back to the starting point, and then during the press conference is when it decides whether it wants to continue up or whether it's going to be a spike reversal. The FOMC is very, very, very commonly known for the spike reversal pattern where the market will go up a lot, but then as the press conference takes place, it slowly starts to drift the other way and then it will eventually end up going the other way. A lot of people in my group call it the porcupine pattern. It almost looks like a spike reversal, like a porcupine. But yeah, that's what we're going to be looking out for to see if we get the old porcupine pattern or not. What's this say? 3.5 to 3.75. PCE unemployment rate is 4.4, PCE is 2.8, GDP is 4.4. Really, the U.S. economy is really not in that bad a shape. I know that there's a lot of drama going on in the U.S. right now. Nobody's going to deny that. But as far as the U.S. economy is concerned, it's still in very, very good shape. I like to use this website, Trading Economics. It's a really good website to take a look at, previous news events and things like that. So right now, PMI is an important number. Anything above 50 is basically good. Anything below 50 is considered bad. So it's above 50 all the way across. Inflation 2.7. I mean, obviously they'd like it a little closer to the 2.0 range, but that's definitely not too bad. Unemployment is a little on the high side, 4.4, but it's definitely not unreasonable. So, like I said, I mean, the U.S. economy is really not doing that bad. Retail sales is definitely not the greatest, but it's not too bad. And you can take a look at this website if you want, and you can just take a look at any. They have all the major countries, all the news events for the major countries you can look up. So it's a very good website. There's a lot of really good information on this website. It's tradingeconomics.com. But anyways, yeah, let's get started. Let's see if we can figure out what this dollar is going to potentially do. I always prefer to use the US dollar index because I do much prefer that over the US dollar, the DXY that is. The DXY is 56% weighted to the euro dollar, which means it's basically exactly the same picture as the euro dollar, but in reverse. This picture right here and this picture right here is basically exactly the same. One thing that is important to note, though, is that we're not at a Fibonacci level right now. We're actually not really even. This is the weekly time frame, so we actually still have a decent amount of downside before we even get to the next Fibonacci level. And for about a year or more now, I've been saying that this is one, two, three waves down, one, two, three waves up, and now this is one, two, three waves down for a triple three pattern. Three waves down, three waves up, three waves down, which is a WXY if you're talking about Elliott wave terms. And I have my Fibonacci retracement on this whole last impulsive move up from here to here. The market, in my opinion, I trust Fibonacci retracement and Fibonacci extension more than anything. Fibonacci is an extremely powerful tool, and if you know how to use it, it definitely works, I would say, better than 90% of the time. You don't really necessarily know exactly which Fibonacci level it's going to turn out always, but the market almost, I would say, 90% of the time or better, the market almost always turns at a Fibonacci level. If it goes below the 78% Fibonacci, that's also a really good hint that it's actually probably going to go down and take out the lows. But for at least a year now, I've been saying this is a WXY pattern on the DXY. If you go back to the US dollar index, which, like I said, is the one that I much prefer to use, then the 100% Fibonacci extension has been my target. I've had this 100% Fibonacci extension on my chart for probably almost a year now, this little box right here. It definitely since last summer I've had this box here because what this is it's a 100% Fibonacci extension of the three waves of W projected off the top of the three waves of X because a wave Y often is going to be right around 100% of the wave X. The market likes to be symmetric. Almost all the waves in the market are very symmetric with the previous waves. And when the market stops being symmetric, that's actually a pretty important clue that potentially a pattern is complete. But anyways, this 100% Fibonacci extension is right here. It also lines up perfectly with the 61% Fibonacci retracement. So for me, I think there's a very good chance that the dollar is not finished with its move down. So let's go down to the daily time frame real quick. Now, I know I spent a lot of time analyzing the dollar index, but to me, if I know what the dollar index is doing, then I literally know exactly what direction I should be trading on the euro dollar, the pound dollar, the Aussie dollar, the Kiwi dollar. I also know what direction to trade on the US dollar CAD and the US dollar Swiss. The US dollar yen is more of a yen pair. It's more correlated to the yen pairs, in my opinion. And gold does whatever gold wants to do. So I can't really use the US dollar index as an indicator for gold. I personally do not trade gold because I'm from the United States. I have never traded gold in my career because I'm from the United States, and you cannot trade gold on a margin account in the United States. You cannot trade gold with leverage in the United States unless you're using a prop firm account or you're using like futures or something like that. So I never traded gold since I've been trading since 2009. I have never once traded gold. Now I live in Europe. I can trade gold, but I spent 12 plus years not trading gold, so I see no point in trading it now. But anyways, I do analyze gold a lot because gold is an extremely popular pair, but it's not a pair that I personally do trade. If anybody is interested, like I said, in joining my membership, definitely check out my website. It comes with a ton of benefits. The link is fxpipcollector.com. I share every single trade I take with the group at the exact time of entry. I am currently running the Kelly criteria formula on my trading account, which is how some of the best traders in the Market Wizard books were able to produce extremely high returns. So I'm currently starting a 1,000 euro trading account, and I'm trying to turn that 1,000 euros into 10,000 euros. If I can turn that 1,000 into 10,000, then I'm going to take that 10,000 and turn it into 100,000 using the Kelly criteria formula. Which, if you want to join my membership, you're going to learn all about that type of stuff. And if you want to follow along with all my trades, you're more than welcome to do so. It is only $30 a month. I keep it extremely cheap because I want to make a fortune from my trading, not from my memberships. I really just want to build a community of like-minded traders that are willing to help each other out. But definitely check out my website. It is extremely cheap. I do share every single trade I take with my group at the time of entry. That 1,000 euro trading account, I am currently up 25% on that account, and I just started trading it this week. I reset the account this week. I just started with the first 1,000 euros, and I'm currently up 25.5% on that account in about 3.5 days using the Kelly criteria formula. So if anybody is interested, definitely check out my website for $30 a month. I think you're definitely going to get your money's worth. But anyways, now that pitch is over. I personally think the dollar move down is not over. I think this is a wave one. I think this is a wave two. I think we're clearly in a wave three. If this is a wave three, then it is very likely going to go down quite a bit further. We're not sitting at a Fibonacci retracement level, and my target is still down quite a ways. So I still think there's a very good likelihood that the dollar index is going to keep going down. Also, I have my Fibonacci extension from here to here, projected off the top of here. I have my Fibonacci extension on the wave one, projected off the top of the wave two. Now, a wave three projection is normally minimum the 161.8% of wave one. And it's really nice how all these Fibonacci levels line up. I got the 100% Fibonacci extension of wave W lining up right here inside this box. I also have the 61% of the weekly time frame move right here, and the 161, 178% is right here. So I got three separate Fibonacci levels all lining up to one area in the market, which is why I think there's a very good chance that this is going to keep going down. I use Oanda. I've been trading with Oanda pretty much since probably about 2009 or so. I know Oanda is not good for scalping, but I am definitely not a scalper. I have no desire to be a scalper. I've never been a scalper in my life, and I have no desire to do so. As you can see, I don't even really have the sort of time frames on my chart. I have the 5 minute there just because I put it on there for other reasons, but I never, ever look at the sort of time frames ever. I take 99% of my entries on the 2 hour time frame and above. I personally do not want to live my life staring at the charts. I can make a lot of money trading the 2 hour time frame. Yeah, I also do day trading. A lot of my trades are day trades. You know, my average trade is probably between 8 hours and 3 days. But I never, ever look at the sort of time frames ever. So, anyways, on the I'm on the 2 hour time frame just because I'm used to the 2 hour time frame. And my videos I go down to the 1 hour, but to be honest with you, I normally don't even look at the 1 hour time frame when it comes to my own personal trading. Now, if the dollar index goes up and breaks this high right here, that's going to invalidate the idea of this being a wave three. If the dollar index doesn't go up and break that high, then it's likely just a pullback to this last wave down. It could bounce from any one of these fib levels, and it potentially could keep on going down. To be honest with you, I normally don't enter trades at this news event. I used to, but I'm kind of tempted to enter a trade tonight because it seems very clear that it's going to keep going down to me. The problem is you could be absolutely right. You know, the market could end up going down, but then it could literally go up and do a spike reversal, stop everybody out, and then continue down just like you thought it was. So these news events are a little dangerous to enter prior to the news. Right now, we're going to focus on the dollar pairs, but after the news is out, we'll definitely check it out. Now, I know that I spent 15 minutes going over nothing but the dollar index, but now that I have a good idea of what the dollar index is doing, I can literally know exactly what I want to do on the euro, the pound, the Aussie, the Kiwi, the CAD, and the Swiss. I do not use the dollar index for the dollar yen, and I do not use the dollar index for gold. But now that I've spent 15 minutes on the dollar index, I know exactly what I'm looking for on the euro dollar and all the other dollar pairs. The euro dollar made a big pullback today. And I definitely don't disagree that this does look like it could be a different pattern. I do not disagree that this looks like three waves down here. I do not disagree that this potentially looks like a WXY three waves up. I do not disagree that it potentially could go down and do this. Definitely could play out like that. It does have that 333 look to it. Oh, good. I really do enjoy making the videos. I really do enjoy helping people. I do have a big passion for the markets. I just have a very little passion to sit in front of my charts, 8, 10, 12 hours a day, which is why I am a swing slash day trader. I will not ever be looking at anything really below the 1 hour time frame. So anyways, the euro dollar is actually pretty strong down. It really doesn't look corrective at all. But because of the dollar index, I still think there's a pretty good chance that this could end up going up at one more time. Now, if it does break and hold below this line right here, then that definitely does change everything, and I definitely at that point will become bearish. And that analysis I just showed you on the daily time frame is going to probably be valid if it does break below. Pound dollar, like I said, every single analysis that I'm looking at is based on the one analysis I did. The $1 analysis tells me exactly what I think is going to happen on every single dollar pair except for gold and the dollar yen. Pound dollar. If the pound dollar breaks below here, then I will be more than happy to admit that the daily is back down and that I'll start looking for shorts. Otherwise, this move down is very likely just a pullback within an uptrend. Aussie dollar. Aussie, by the way, has been an extremely strong currency. I definitely wouldn't be trying to sort this. This is a trade that I took yesterday. I traded it from here to here. I also traded the US dollar CAD to the short side yesterday. Very good trades. Like I said, I'm only trading. I have two accounts, but my smaller account, that 1,000 euro account that I'm trading, I'm currently up 25% on that account using the Kelly criteria formula, which you're more than happy to follow along with me if you are a premium member of on my website. But anyways, Aussie dollar, same thing. If it breaks below here, I'll be bearish. Otherwise, if it goes down, I'm just looking at that as possibly another opportunity to go long. Only looking for logs on the Aussie dollar. Kiwi dollar, I don't analyze any of the Kiwi pairs. I don't trade any of the Kiwi pairs. I don't really even analyze them. I do keep up with them on the weekly and the monthly. I still think there's a good chance this Kiwi dollar is going to go up a lot over the next, year or so. But it's literally exactly the same thing as the Aussie dollar most of the time, which is why I don't really analyze it. And the Kiwi spread can be terrible sometimes, which is another reason why I don't really trade it. A lot of times during market turnover, the Kiwi spread can get so wide that you could have your stop loss right here, and the market would be way up here, but the spread is so wide that it can stop you out at the market turnover at 10 p.m. London time. But anyways, same exact thing. This right here is probably very likely a pullback to this move up unless it takes out this low right here. If it does take out that low, I'll be more than happy to, stop being bearish. US dollar CAD, this is the trade that I said with the group yesterday. I went short literally like right here yesterday, and then I got out right about here last night. Very good trade. It was about 113 pips or something. This is my Discord channel too, by the way. Today I went long on the pound yen, made 113 pips on that. Yesterday I went short on the US dollar CAD, 123 pips, and I also went long on the Aussie dollar for 51.7 pips. Every single trade is said with the group at the exact time of entry. It's on my Discord channel. I don't intend this to be a signal service, even though a lot of people do use it as a signal service. But I do enjoy sharing my trades with the group as long as people are willing to learn also. US dollar CAD, kind of the same story. I mean, definitely looking for shorts. There's no reason to be doing anything right now, in my opinion, than looking for shorts. This could be a little bit of like an expanding or a running pattern right here. This could be the A right here because it looks like 1, 2, 3, 4, 5 ways down. That could be the A. This could be the B. This could go up for a C, 50, 61%, and then back down again. In my opinion, I would be doing nothing but looking for shorts on the dollar CAD. Now I know that I just ran through all these dollar pairs really quickly, but it's because of my US dollar analysis that I literally know what to do on every single one of these dollar pairs. I know what to look for. I could pretty much only analyze the dollar index and then I could just blindly go to the dollar pairs and trade accordingly, only based on the dollar index alone. Yes, I will definitely take requests. I'll look at the pound yen and Bitcoin or whatever people want once the news is out. So I am definitely looking at the dollar Swiss move to the upside as possibly a pullback within a downtrend. As long as it doesn't take out this high right here, I am definitely very bearish. Now let's look at the dollar yen because this is not a dollar pair in my opinion. This is more of a yen pair. Now, obviously, tonight's news is going to affect the dollar again, but this definitely does have that expanding flat look to it. I think there's a chance that all the yen pairs could make one more wave up. I think everybody is going to be looking at this move down that the yen pairs made this week and last week as a start of a big move down, which it definitely could be. But I think the market's not going to make it that easy. I think the market's actually going to push up, probably stop everybody out before it decides to really go down on the weekly time frame. So the yen pair, my yen analysis is definitely a little different. Now, obviously, tonight's news is going to affect this too, and if the dollar goes down, this will probably go down also. But I think there's a good chance that this is eventually going to go up. So I personally am waiting for a break of structure up, and then I'm waiting for a pullback, and then I'm going to go long, and hopefully it's going to go up and continue the uptrend like a wave one, wave two. To be a good swing slash day trader, you need to have patience. It's not like there's going to be opportunities every minute or every day. Sometimes I don't even enter a trade every day. I probably average 3 to 5 trades per week. Actually, probably more like 3 to 8 trades per week. But especially if you use something like the Kelly criteria formula, you can make more than enough money with 3 to 5 trades per week. Easily, easily. And moving on to gold, I mean, gold is just unreal. I thought that gold was going to potentially stop at the $5,000 area because I did have a Fibonacci level that lined up perfectly with the $5,000 area, and then it just kept on going up. So obviously, we need to watch every single one of these Fibonacci levels to see if there's a break to the downside. But why even worry about the top? Why would you be concerned with the top? I had to laugh at something that one of my premium members said today in Discord because he said that he's literally just closes his eyes and goes long on gold almost every day and he makes money almost every day doing it. He just literally closes his eyes and goes long and he makes money. Most retail traders are looking at this and saying, man, what am I going to go short? Can I go short here? Can I go short there? Can I go short here? Can I go short there? A good trend trader doesn't really give a crap when the top comes in because they'll know when the top is in because they'll see a breakdown or they'll see engulfing down. A good trader is looking at every single pullback as an opportunity to go long. So they're like, oh, long here, long here, long here, long here, long here, long, 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 and just making money all the way up. Unfortunately, in my opinion, there's really not a whole lot of analysis to be done on gold right now. What would I be doing on gold? I would be looking to go long here. I'd be looking to go long there. I'd be looking to go long there. I'd be looking to go long there. I'd be looking to go long here. If the gold goes down, guess what? I'd be looking to go long. I would not be looking to go short on gold until we get a reason to go short. And the reason to go short would be not a break of structure on the 1 hour, but a break of structure to the downside at a Fibonacci level would give me a reason to go short. A break of structure down on this 1 hour time frame is not going to tell me anything. This break of structure right here didn't tell me that it was time to go short. This break of structure right here didn't tell me it was time to go short. A break of structure down on the 1 hour time frame is not going to tell you anything whatsoever, except for that the last little wave is over. It could just be another pullback within an uptrend. So let's go down to a little bit of a short time frame just to see if that made 3 waves up or if that made 5 waves. Oh yeah, that does look like a corrective pattern. I bet this is going to either be a running or an expanding. Gold loves to make flats. If you are a gold trader, which, like I said, I am not a gold trader, but if you are a gold trader, you definitely need to learn what a flat pattern is because market gold loves to make flats. It loves, loves, loves it. Yeah, I'll definitely look at the pound yen once the news is out. We have about 4 minutes until the news is out, and then we're going to spend 30 minutes taking requests. I'll look at basically anything that anybody wants me to look at. So if you have something you would like me to look at, then definitely put them in the chats. I'll definitely look once the news is out. So we pretty much know exactly what we're looking for, right? On gold, we're definitely doing nothing but looking for logs. Dollar yen, we're technically looking for shorts, but we are keeping an eye out for proof that it's going up. Euro dollar, definitely logs. Pound dollar, definitely logs. Aussie dollar, definitely logs. Kiwi dollar, definitely logs. US dollar CAD, definitely shorts. US dollar Swiss, definitely shorts. All the everything I just said except for gold and the dollar yen is based on the US dollar analysis. Which, by the way, the US dollar is not even close to a Fibonacci level right now, which is why I'm pretty confident that it is going to hit this 100% Fibonacci extension and the 61% Fibonacci retracement. And the 61 178% Fibonacci extension of this wave projected off the top of this pullback. Whether or not it manipulates, not it's not really manipulation; it's just liquidity grabs. But I'm not really a big believer in manipulation in the markets. It's not really manipulation. It's just big money traders grabbing liquidity. They're not really manipulating it. They're just trading. They need your liquidity. They need you to, lose trades in order for them to win trades. So, anyways, we got. Let's get this queued up. Like I said, definitely check out my website. Like I said, I'm up 24, almost 25% on that account that I'm trading with my group. So definitely check out the website if you're interested in that. It is only $30 a month. Anyways, we got 2.5 minutes. Let me make sure I'm logged into my trading account on my other screen. I have 4 screens, and my other screen I have my trading account ready to go. Oh man, do I want to try to put a little trade on at the news? That's kind of the question. I am kind of tempted to, just because I feel like it's so clear that it's going to go up again, but it's a little bit of a risk because, like I said, you could be 100% right about direction, and then it goes down, stops you out, and then goes up later on, and then reverses later on, does this, and then this is like a 3 4 5, and you get stopped out here, and then you try to go long, you get stopped out there, then you try to go short. It can be quite the mess sometimes. I personally think it's going to go up though. The pound dollar is the one that looks kind of interesting to me also. Maybe I'll put in just a play trade. Use like 150 pip stop loss. If I make 50 pips, I make 50 pips. Risk 150 to make 50. That sounds like a good risk to reward, huh? Probably not. Hmm. Yeah. I think it's gonna go up again. It could just be a little spike reversal though. Yeah, I'm gonna enter a little play trade on it. It's literally like a fraction of what I would normally enter on the pound dollar. I'm gonna use a big giant stop loss, and I'm gonna risk a tiny amount of money. And I'm probably just gonna take profit around the highs. What the hell? I don't really care. See what happens, I guess. Hey, let's see what happens. We only have seconds until news comes out. It's probably not going to be a big giant mover in my opinion, but it could be. Let's see. Still pending. Yeah, no change in rates. I mean, unfortunately, I think pretty much everybody knew that this was what was going to happen. So the interest rates were 3.75. They were forecasting 3.75, and they came out at 3.75. So there was definitely no surprise in the market. When the market is not surprised, it usually doesn't move a lot. Like if they had raised interest or lowered interest a little bit, that's when the market would have made like a big old giant move. Sometimes the market at these news events can make, 50, 100 pip moves plus all in a matter of seconds. Let's see if the pound dollar goes up. I mean, I might just take profit. If it goes up to the top, to its previous high, I'll probably just take profit there. Like I said, even if it is just a little profit, I don't really care. Mm. All right, let's see. Not a lot of excitement. Oh, Kiwi dollar's pushing down. US dollar CAD's trying to push up a little. No, no change in rates. Not really a big surprise for anybody, honestly. Yeah. Gold looks like it wants to go down. Like I said, if you're a scalper, maybe you could try to scalp to the sell side, but I would be very cautious because it could just literally go down, break structure, and go up, or it could even make a higher low. It could make a higher low, and go up too. So I really don't recommend shorts. I haven't recommended shorts on gold in months. And anybody that's been following a lot of my videos and listening to me not recommend shorts on gold pretty much since last August, I know my gold videos have probably been pretty boring lately, but literally every single day since last August, I've been saying, look for longs on gold, look for longs on gold, look for longs on gold. Anybody that's been listening has probably been doing pretty damn well because it has been going up. I was definitely expecting it to find resistance at 5,000. Uh, Somebody in our group today has sold a channel that they had on their charts that was right between like 52 to 5400. So it definitely could find resistance soon, but it definitely hasn't found it yet, unfortunately. So, anyways, we have about 30 minutes until the press conference starts. The press conference starts at 7:30, which is 30 minutes from now. This is where I normally take requests. So if somebody has something they would like me to look at, definitely put it in the chats. I'll be more than happy to look. I'm gonna drink my coffee. I know it's a little late for coffee. It is 7 p.m., but FOMC day is always a very long day for me because I also need to make my PM videos for my members at the end of this live stream. Plus, I live in Portugal, and in Portugal they drink coffee all day and night, so it doesn't really matter. Espresso, 80-cent espressos day and night. So, anyways, if you want me to look at something, put them in the chats. I know there's already some stuff requested, but the people that are still here are the ones that are going to get stuff looked at. So put in a, yeah, the 1 minute. You're not going to find me looking at the 1 minute menu. That's for sure. I do, like I said. I mean, I really have nothing bad to say about scalping. I mean, I do understand that scalping is definitely good if you want to and you enjoy doing it. But for me personally, it's miserable. Nothing is more miserable to me than sitting on the very short time frames watching the charts. So it's just not what I do. But I do understand that people are good at it, and if you have a good system, you definitely can make good money doing it. But I will never be convinced that I need to be on the 1 minute time frame to make money. That's for sure. Definitely not. But you definitely can see breaks of structure before, on quicker, and you definitely can see turns quicker. And if you're good, you definitely can make money on the short time frames. Anyways, let me start off. I saw the pound yen a couple times, so we'll start off with the pound yen. This list right here are the pairs that I've watched, but I can look at Bitcoin. I can look at basically anything. The pound yen is a trade that I went long on today. I just got out way before the 100%. I literally just got out way before this news event started. All the yen pairs to me are tricky to know whether they really have made the turn or not. Some of them look like they have, and some of them do not look like they have. To be honest with you, the pound yen is actually one of the ones that I think has not made the turn. We're not even sitting at a Fibonacci level yet. We're kind of right in between two Fibonacci levels. So to me, the pound yen is actually one of the ones where I'm like, man, this really doesn't look like it's actually made the turn. I am on the daily time frame. It definitely did break structure, but it's like rejecting structure almost instantly. It doesn't look like it's holding. Yeah, well, I do look at the 1 hour once in a while, just because the 1 hour can show you some structure. But yeah, definitely. The 1 hour is all right. I think the 30-minute time frame is kind of a happy medium. That's kind of a mixture between day trading and stuff. But the pound yen, oh well, that's not even in the right place really. I would probably want that right there. The pound yen did break structure, but it rejected structure almost instantly. And it definitely looks like it went up in three waves. It looks like it made three waves down, which was pretty strong, up in three waves, and then five waves down. Kind of looks like to me it's making a flat. It kind of looks to me like it might just keep on going up, which is why I took a long today. But because of the news, I ended up getting out, and because I'm trading a high risk account right now because I'm trading that Kelly criteria formula. So with that Kelly criteria formula, I'm risking a lot of money per trade based on the size of my account. So I definitely try to, cut losses very, very quickly, and I definitely try to take profits when they're available because when you're risking that much money, things can go bad pretty fast. The question is whether this right here is now back into the uptrend, which I think it definitely could be, or whether this is an ABC right here. It definitely made, a move to the upside, which looks more like three waves, which actually makes me think that it is a wave A. It made me go, it went down in three waves, which definitely looks like a wave B, and now it made an impulsive move up. So it definitely looks more like an ABC to me. It might end up trying to fill this gap right here. I mean, there is definitely a gap in the market right here that it might end up filling. But if it breaks to the downside at the 123, the 100, or the 138, then it's on wave C and it's going to go down and make new lows. If it keeps making higher highs, higher lows, which honestly you probably would have to be on the 30-minute to see the higher highs, higher lows, high, low, high, low, high. If it breaks that high, low series at any one of these key Fibonacci levels, then it is more than likely a C, and it's more than likely just going to keep on going down. If it doesn't break that, but instead makes a higher low, makes a higher low, and just keeps making higher highs, higher lows, then it's obviously a wave three, and you would just keep on looking for longs every single chance you get. Yeah, I can look at the Kiwi yen. I don't analyze the yen pairs, the Kiwi pairs, I'm sorry, the Kiwi pairs, but I'll be more than happy to look at it for you. This one does kind of look like a wave B, doesn't it? It looks like a wave B more than most of the other ones do. Man, this isn't even at a Fibonacci level either. I'm really not convinced that the yen pairs are turning down. I think that the yen pairs are trapping people in a sell, and I think the yen pairs are going to keep going up, to be honest with you, on the high time frames. That doesn't mean there couldn't potentially be a decent move down on shorter time frames. But I'm really not convinced that this big old giant push down that we had on all the yen pairs is anything beyond just a bear trap, especially on the Kiwi yen. Look at this. Higher low, higher low, higher low, higher low, higher low. There's definitely no lower high. There's definitely no break of structure. The trend is definitely still up on the daily, 100%. That doesn't mean that it has to go up, but it could end up making an A, B, C, or a 1, 2, 3 breaking structure and going down. I'm just saying that right now the trend is definitely still up on the Kiwi, 100%. It definitely does have that wave B look though when you go down, doesn't it? It looks like a 1, 2, 3. Yeah, I think most people would count this as a 1, 2, 3, 4, 5, but I definitely wouldn't because the symmetry is not there. I think that this is a 1, 2, 3, 4, 5 A. I think this is 1, 2, 3 B. I think this spike right here is the wave C, and I think this could just keep on going up. To be honest with you, maybe it is going to go down at some point, but like I said, I definitely think the yen pairs will turn down at some point, but I'm not really convinced it's going down yet. I really don't like the Kiwi pairs because, like I said, the spreads get so freaking wild at the market turnover. I don't know how many times, like, let's say I was short, even long. Let's say I was long the Kiwi yen from here. My stop loss was here, and then at the market turnover, the spread got so wide that it stopped me out, even though price is actually way up here. The spread was like 100 pips at market turnover. But no, I mean it could go down. Like I said, it definitely on the 1 hour time frame. This is why I'm really not a fan of the sort of time frames though. Also, if I was analyzing the 1 hour time frame all by itself, I would say the Kiwi dollar is going down. I would definitely say Kiwi down. And I think that is the problem with retail traders and the problem with the sort of time frames. Because right now I would look at this and I would say that really looks like an A, B, C. It really looks like it's going to bounce from a fib, and it really looks like it's going to go down, which it definitely could. And if it does break down at the Fibonacci level, it probably is going to keep going down. The problem is the daily time frame looks like it's going to keep going up. What do I trust more? I definitely trust the daily and the weekly more than I do the 1 hour. Yeah, I can take a look at oil for sure. We got a little bit of time before the press conference. I can look at anything. Like I said, I can look at crypto. I can look at crypto, commodities, indices, indexes. Doesn't really matter. Oh man, did oil go up? I was thinking about swing trading oil, but I don't trade this normally, so I didn't. But oh man, look at that. Oh, shit. Kind of messed that up a little bit, but hopefully they're still pretty close. I haven't looked at this in quite a few weeks, probably since before I went on my Christmas vacation. But I still think that oil is going to go up. I still think oil is going up to about $100 per barrel. I think is my more likely target. Maybe it's not an ABC either. Maybe it's a WXY. It's starting to look more like a ABC. ABC of Y. Maybe this is an ABC of X, and then this is an ABC of I'm sorry. Do we? This is ABC of W, and then this is ABC of X, and now we're in ABC of Y, pushing us up to about $100 a barrel. I like that analysis, actually. I think I like it better than what I have. Like I said, I don't trade this. I was thinking about swing trading it to the upside because it seemed very clear that it was going to go up, but I didn't end up trading it because I wasn't watching it close enough. It really looks like a WXY there, big time. It's definitely breaking structure on the sort of time frames too. That's a good sign. I bet it's going to keep going up. I would definitely be bullish. I would definitely be looking for pullback entries to go long. I thought I changed this setting on this. I know a lot of people have said my Fibonacci levels are so light that they can't see them, which I agree, they are very light. So I changed it recently, and I thought I saved it, but I guess not. But hopefully that's a little better. Hopefully you can actually see that a little better. Yeah, I would definitely be very bullish on oil. I think oil is going to keep going up. I think oil could go to $100 a barrel. Obviously not all at once, but I would definitely be looking for pullback entries for longs. I definitely wouldn't recommend long now, but I would definitely be looking for longs. It'd be nice to see a breaker start to down on the 1 hour, kind of like what happened here. A breaker starts to down, then put your Fibonacci retracement on the last move, and then try to get in on the Fibonacci bounce for another impulsive up. So really, I mean, honestly, I would have to take a picture out of my mentor's book and say the strategy right now on oil is to be long from here, or maybe there, looking for an exit. Or the strategy is to be waiting for a break to the downside so you can throw your Fibonacci retracement on there and hopefully identify the end of a pullback to get long again. Yeah, definitely. We got some time. We got about 14 minutes until the press conference, so I can look at some other stuff, definitely. Let's see. Let me check out crypto. I have not looked at Bitcoin probably since before Christmas holiday either. It's probably last time I looked at Bitcoin was probably the beginning of December. So don't mind if my analysis is not correct. This you asked for Ethereum though, right? So Ethereum's right here. Definitely still an uptrend on the higher time frames. I would put my Fibonacci on the weekly on this whole move up. That's going to be, in my opinion, that's going to be the most relevant Fibonacci level to watch is this weekly time frame one, because this move down right here could just be a pullback to this last move up. This move down also looks impulsive, which makes me think that it's only a wave A, which makes me also think that it is going to go up, but the next move up is going to be a crutch into this move down, and then potentially down again, and then maybe, you know, 6 months from now, continue the uptrend or something. 4, 5, 6 months, something. Yeah, I think that's probably correct. I think this is a wave A. I bet it is going to go up, especially with these 1, 2, 3 waves down right here. I bet it is going to go up, probably into this area, make a wave B, and then I bet it's going to go down to either the 61 or the 78 for a wave C, and then it's probably going to continue the uptrend a few months from now. So on probably roughly the 4-hour time frame, I would be putting my fib level on the whole move down. But I would use this high right here, not this one, because that is definitely the 345 right there. That is definitely a truncated wave 5 right there, meaning a lower low wave 5 in an uptrend. So I would put my Fibonacci on the whole move down from here to here. Well, I mean, it kind of depends on what kind of trader you are too. Actually, probably the most relevant Fibonacci level right now is actually this fib level, but it kind of looks like it's already ended. So yeah, it bounced off to 78%. If it breaks that high right there, then it's probably going to go up and make a wave C. This is your A, this is your B, that's a C. A, B, C, or B. This is your A, and then down again. Definitely looks like that's the most likely scenario to me. So this is why I would be using this Fibonacci, even though it technically hasn't even broken that high yet. Because a wave C is probably going to go up to a Fibonacci retracement level, and it's probably going to go to a Fibonacci extension level of wave A, projected out the low of wave B, which is actually right here. And then you want to look for Fibonacci clusters. The 100% Fibonacci extension of wave A lines up really well with the 50% Fibonacci retracement of the whole move down, which also lines up pretty well with the support here, which also lines up really well with resistance over here. So I would say there's probably a pretty good chance that Ethereum is going to 3,700. And then there's probably a good chance that it's going to go down to about 2,600 or maybe even lower, maybe 2,200. And then there's probably a good chance months from now that it's going to go up and make a new high. So, anyways, I would be looking for longs, but I would definitely be waiting for this break of structure right here to help confirm that it really is going long. If it breaks that high right there, then it's probably going up to whatever level I just said there. What did I say, 3,600 or something? 3,700, something like that. Anyways, we still got about 10 more minutes until the press conference starts. If anybody wants to request something, I always like to spend a good half an hour in between the news and the press conference analyzing. Actually, I'll leave that one there. Analyzing pairs that people request. So if anybody wants me to look at something, put in the chats. Excuse me, I'll be more than happy to look. Let's see. There's a decent amount of news this week. We had Canadian news today, which they also did not lower rates. Tomorrow we got unemployment claims for the dollar. We have CPI. We got inflation reports for Japan, which is probably pretty important for that for the yen pairs. Tomorrow, and then Friday we got PPI and GDP for Canada. This German inflation data. I mean, obviously Germany is one of the bigger economies in Europe, so it is important, but it's not like a big deal. GDP is not like a big deal either. It probably is going to move the euro a little bit because, like I said, Germany is one of the bigger economies in Europe, but it's probably not the biggest deal ever. We got interest rate for the pound next week. We got interest rate for the euro next week. We got interest rate for the Australia next week. So pretty important couple weeks we got coming up. That's for sure. Unfortunately, like I said, a lot of the big moves lately are not happening because of this scheduled news. A lot of the big moves are happening because of drama with geopolitics, which I personally try to do my absolute best to pay zero attention to. I definitely much prefer not to pay attention to that stuff. So, anyways, yeah, does anybody have any requests they'd like me to look at? Yeah, take a look at silver for sure. Silver's another one that's been on a big old giant rip, huh? Just insane. Silver and gold are just out of control. Look at the monthly time frame. Holy crap. There's no doubt in my mind that that's a wave three. I mean, how can you say it's not a wave three? Look at that. That's crazy. Definitely a big old giant wave three. I don't even think I have enough Fibonacci extension levels to even. Yeah, I don't. We're beyond the 361% of wave one right now, so I don't even have any Fibonacci levels to put on there. I could add more, but I'm not going to do that because that's too much of a pain right now. So what I would do is I would go to a time frame where I can actually identify highs and lows, which is probably like the 8 hour time frame. I would definitely be doing nothing but looking for longs, just like on gold. That's for sure. I would try to identify the last impulsive move and project it off the last corrective move for areas of resistance and support. Man, that's a hard one to even figure out where that would be best done. I throw a few different levels on here. So yeah, now that worked perfectly there, so that's good there. I think you would have to just keep on doing this. That went out to 150, so that was perfect there. I guess it would be this wave right here. It would be the most relevant Fibonacci, which actually that puts you up to there. Hmm. It's really then when you're in all-time highs like this, the only thing you can do is Fibonacci extension. There's really no other choice. It really looks like it's in a way B, doesn't it? I mean, honestly, on this time frame, it does look like it's going to go down before it goes up. But with that trend we just saw in the higher time frames, I have a really hard time recommending shorts to anyone. It really looks like a wave A. It looks like a wave B. It looks like it potentially could go down for a wave C. Maybe grab these lows and then go up again. So I don't know. I mean, honestly, on this 1 hour time frame, it does look like it would go down, but it, this is the type of analysis that gets you in trouble. Because if I looked at the monthly, I would say nothing but longs. If I looked at the weekly, I would say nothing but longs. If I looked at the daily, I would say nothing but longs. If I looked at the 4 hour, I would definitely say nothing but longs. And then you go down to the 1 hour time frame and below, and you start saying, "Man, this could be a wave A. This could be a wave B. This could go down. I could sort this for a wave C." And then you go sort, and what happens is it goes up again because every single higher time frame is in a dramatic uptrend. So to me, it definitely looks like a potential ABC pattern like this. But there's a good chance that it's not going to do that. There's a good chance that this is another ABC within an uptrend and it's just going to keep going. So it's kind of like gold. Unfortunately, I would be recommending nothing but longs on gold. There's really nothing else to say. Every single time it goes down, you should be looking at that as an opportunity to go long until you get a break of structure on like the daily time frame, maybe 4 hour time frame, someplace in that range. So definitely recommending longs. Are these other ones like platinum and palladium in such strong trends too? Oh wow, it is too. This one is palladium, right? Platinum. Platinum is XPT. Palladium is CPD. Palladium is definitely not as strong as platinum and gold and silver. That one is very strong. Wow, that's definitely a wave three also. This one looks like it could potentially be getting close to ending a wave three. Gold and silver definitely do correlate with palladium and platinum. Gold, silver, palladium, platinum, all are correlated. If I personally was a gold trader, which like I said, I am not a gold trader. I never trade gold. Then I would definitely use all four of these pairs as correlation. My old mentor was a big gold trader, and what he did was he would use other gold pairs for correlation. He would look at gold versus the euro, he'd look at gold versus the CAD, gold versus the pound, gold versus the Aussie, gold versus the Kiwi, gold versus Swiss, and gold versus the yen. And then he would trade gold versus the dollar based on the correlation between all the other gold pairs. Gold versus euro, definitely on only longs. Gold versus the CAD, definitely in an uptrend. Gold versus, yeah, definitely uptrend, definitely uptrend, definitely uptrend, definitely uptrend. Not really much to say about gold except for long, just like silver. Anytime they go down, you need to be looking at them as a possible opportunity to go long. What else would you want to do? Until the market tells you otherwise, there really should be no other options. We got the press conference starting shortly. This might not be the best place to watch it, but we'll see. We still got a couple minutes. Does anybody else have any last minute requests? Let's just go back to the dollar real quick and see if anything happened with the news. Didn't really do much, did it? Kind of pushed down a little bit. Yeah, not really much going on. Let's see what. I'm not sure if it's Powell. Like I said, it might not be Powell. It might be somebody else. I'm not sure who's talking today, but somebody is definitely talking. I think it's Powell, but it could be somebody else. About a minute and a half or so until the news starts, or until the press conference starts. Like I said, definitely check out my website. It is only $30 a month. It is extremely cheap. I do share every single trade I take with the group at the exact time of entry. I really don't like to consider it a signal service, even though a lot of people do use it as one. It comes with a trading course, which is about 35 videos, which at some point I'm going to add a few more videos to that. Covers a lot of topics. These are all the videos for my trading course. Each one is, anywhere from 7 minutes plus. Lots of really good educational stuff. On Discord, I have a ton of educational information. Pretty much every LEWay pattern. I have my trade plan for entries, my trade plan for exits. I have my evening checklist in here for everybody to see, and I have my morning checklist in here for everybody to see. I also have a ton of educational information, including, risk to reward ratios. Pretty much every single LEWay pattern you can think of from the LEWay book is in here, and the bearish and bullish version, all the triangles and stuff like that. This is where I share all my swing trades. Like I said, I am not a short time frame trader, maybe 3 to 5 trades a week. Today I made a long on well, you can see I went long on the pound dollar today also, just recently. But I went long on the pound yen, made 113 pips. And yesterday I went long, short on the dollar CAD, 123, and I went long on the Aussie dollar for 51. And every single one of these trades is set at the exact time of entry. You can see yesterday at 7:47 in the morning, this was my entry, this was my stop loss. I almost never use take profits. Aussie dollar at 9:52 a.m. This is my entry price. This is my stop loss. This is all set exactly at the time of entry. It also tells you when I close the trade. If I move my stop loss, it tells you that. If I put a take profit in, it tells you that. And it also tells you weekly and monthly reports. This is my monthly report for November, I guess. And this is my monthly report for December. It gives weekly reports, monthly reports, daily reports. So definitely, is it starting? Let's see. Definitely, so anyways, definitely check out my website. It's really a lot of good stuff on there. It is PAL. So I'm gonna listen to this.
suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. The temporary shutdown of the federal government likely weighed on economic activity last quarter, but these effects should be reversed as the reopening boosts growth this quarter. In the labor market, indicators suggest that conditions may be stabilizing after a period of gradual softening. The unemployment rate was 4.4% in December and has changed little in recent months. Job gains have remained low. Total non-farm payrolls declined at an average pace of 22,000 per month over the last 3 months. Excluding government employment, private payrolls rose at an average pace of 29,000 per month. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including openings, layoffs, hiring, and nominal wage growth, show little change in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index indicate that total PCE prices rose 2.9% over the 12 months ending in December, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. In contrast, disinflation appears to be continuing in the services sector. Near-term measures of inflation expectations have declined from last year's peaks, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5 to 3.75%. Since last September, we've lowered our policy rate 75 basis points, or 0.75 percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariff increases have passed through. We're well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you. I look forward to your questions.
Chris Rugaber at Associated Press. Thank you. I wanted to ask that you attended the Supreme Court hearing last week on the Lisa Cook case, and Treasury Secretary Scott Bessent criticized that as political. Can you say why you attended and what you would say in response to the Secretary's criticism?
So let me start with I don't respond to comments by other officials, whoever they may be. It's just not appropriate to do that. I will tell you why I attended. I would say that that case is perhaps the most important legal case in the Fed's 113-year history. And as I thought about it, I thought it might be hard to explain why I didn't attend. In addition, Paul Volcker went to a Supreme Court case famously in, I guess, 1985 or so. So it's precedented, and I thought it was an appropriate thing, and I did it.
Great. And then just quickly follow on the job market. You mentioned last month that the household survey might be distorted, and you also mentioned the potential for overcounting jobs. which would suggest that we're still in a negative hiring pace. So do you see the drop in the unemployment rate as solid? And what's the basis for saying that things have stabilized? Thank you.
So, yeah, really two questions. One is, so we're getting through the distortions in the data from the shutdown. However big they were in November, they're smaller in December. So we're getting to a place where they're no longer material. They're still there, but it's a tweak here and there. The reason why we changed the statement, let me pull it out, was simply it used to say that judges that downside risks to employment rose in recent months. So we saw data coming in which suggests some signs of stabilization. I wouldn't go too far with that, but some signs of stabilization. There are also some signs of continued cooling. And so we thought that was no longer an accurate description of the data. In addition, the outlook for economic activity has clearly improved since the last meeting. And that should matter for labor demand and for employment over time. So for those two reasons, we thought we would take that language out of the statement.
Nick Timrose, The Wall Street Journal. Chair Powell, you've generally avoided engaging with political controversies directly, and the video statement on January 11th was a departure. What made this different, and are you concerned it could draw the institution further into political debates?
So today I'm simply going to refer you to the statement that I made on January 11th. I'm not going to expand on it or repeat it. So I'm just not going to. This is really about the press conference and the economy and what we did today, and some ancillary areas. I'm not going to be getting into that.
Can you say whether the Fed has responded to the subpoenas?
I have nothing for you on that today.
Mike.
Michael McKee from Bloomberg Radio TV. Have you made a decision on whether you would remain as a governor of the Federal Reserve? And if so, would you tell us what it is? And if not, when might we anticipate a decision?
No, and I really, once again, have nothing for you on that today. That either.
Why would you want to leave at all under the circumstances?
Again, I don't want to get into it. It's not something there's a time and place for these questions, but not something I'm going to be getting into today. Thank you.
Thank you. Claire Jones, Financial Times. Thanks a lot for taking my questions. In another one that might, lead to a similar answer. We've seen quite big movements in the dollar over recent days. What do you think is driving the US currency lower? And have you been at all concerned just by the extent of the volatility we've seen this week? Thank you.
So, Claire, as you probably know, we don't comment on the dollar. Really, the administration, especially the Treasury Department, has the job of oversight over the currency, and exchange rates and all that. We don't comment on that. It's not our role. So I have nothing for you.
I mean, what's your view on the market movements? I mean, what do you think behind them? Is it asset managers diversifying? Is it?
Yeah, I just don't. We don't talk about the dollar. We don't talk about what moves it around. It's just not appropriate for us to do so. Really, the Treasury Department has that. It's their role, their bailiwick, and we stay off it. We do monetary policy and some other things, but we don't comment on the dollar. Sorry.
Yeah.
Hi, Chair Powell. Neil Irwin with Axios. Obviously, no SEP in this meeting, but in light of the slight firming up of the language around growth in the labor market in the statement, should we assume that the timeline for any further rate cuts is pushed back compared to what people might have thought in December?
Well, first of all, if you look at the incoming data since the last meeting, clear improvement in the outlook for growth. The data have come in, and sentiment, the beige book, everything comes in suggesting that this year starts off on a solid footing for growth. Inflation performed about as expected, and as I mentioned, some of the labor market data came in suggesting we're evidence of stabilization. So it's overall a stronger forecast. It really, if that's your question. I'm not sure I answered your question.
But in terms of timing or pacing of any additional easing?
So we haven't made what we'd say about this was that after this meeting, after the 3 recent rate cuts, we're well positioned to address the risks that we face on both sides of our dual mandate, and we'll continue to make our decisions meeting by meeting based on the incoming data implications and the outlook and the balance of risks. Haven't made any decisions about future meetings, but the economy is growing at a solid pace. The unemployment rate has been broadly stable, and inflation remains somewhat elevated. So we'll be looking to our goal variables and letting the data light the way for us.
Steve Leisman, CNBC, and sticking with questions you might answer, thank you. You had previously, I believe, described the current policy rate being at the higher end of neutral. And if you look at the longer run, the S&P and the longer run rate, 16 of 19 officials are actually below there on their long run. Is the Fed still in a process of bringing it down towards a middle range of neutral? And what would it take to get there?
So the count I did was that 4 of the 19 were at or above that. And then maybe I missed by 1, and I thought it was 4. And if you look at the dealer survey, it was 10 out of 58 where we're at or above. So you're right. It's the higher end of the range. What we say is it's within the range of plausible estimates. This is the higher end of that range, but so for some people they think it's neutral. I think, and many of my colleagues think, it's hard to look at the incoming data and say that policy is significantly restrictive at this time. It may be sort of loosely neutral, or it may be somewhat restrictive. And it's in the eye of the beholder, and of course, no one knows with any precision. If you had a follow up,
I get what you're saying, but some officials have described the Fed being in a mode of bringing it down eventually over time. Are you still in that mode, or is this a place to hang out?
Yeah, no, I would say if you look at the S&P from December, most people had additional normalization. But at the same time, we've done a lot of the process of normalizing. A good piece of it is done with 75 basis points, and before that, 100. It's 175 basis points we've cut since we began cutting in September of 2024. So you've moved now to, Fed funds is running just a little below 3.65%. So you've moved a good way, and we think we're well positioned here to watch how the economy performs, look at the data. We're not making decisions about future meetings, but we do think we're well positioned after those 3 cuts to let the data speak to us.
Amir. Thank you, Chair Powell. Mara Mobley from Bloomberg News. To what extent did the committee discuss the possibility of cutting at this meeting or in March? And how are you all thinking about the conditions that would merit another rate cut? Is there broad agreement on the committee about what it would take?
So there was broad support on the committee for holding today. Broad, I would say, including among non-voters. So that's where that was. Of course, some people did want to cut and dissented, but committee pretty broadly for holding today. We're not trying to articulate a test for when to next cut or whether to cut at the next meeting. What we're saying is we're well positioned as we make decisions meeting by meeting, looking at the incoming data, evolving outlook, and all that. And we're in a position where we still have some tension between employment and inflation, but it's less than it was. I think that the upside risks to inflation and the downside risks to inflation probably both diminished a bit. So we'll be looking at that. It's about how you weigh the risks to the 2 goals and how big those, and quantify them. And so there are different views on the committee, and we'll find our way forward as the data evolve.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Has the effects of tariffs already moved through the economy on prices?
A lot of it has. So basically, there are many different estimates, and they're all highly uncertain. But most of the overrun in goods prices is from tariffs, and that's actually good news, because if it weren't from tariffs, it might mean it's from demand, and that's a harder problem to solve. We do think tariffs are likely to move through and be a one-time price increase. So most of the overshoot, if you were to take that out, you'd get, and you would, I mean, inflation, core PCE inflation is running just a bit above 2%, x the effects of tariffs on goods. And the other good news is, if you look away from goods and look at services, you do see ongoing disinflation in all the categories of services. So that's a healthy development. So that's what's going on. The expectation is that we will see the effects of tariffs flowing through goods prices, peaking, and then starting to come down, assuming there are no new major tariff increases that are begun. And that's what we expect to see over the course of this year. If we see that, if we see that, that would be something that tells us that we can loosen policy. Also, if we see something that suggests that the labor market is not stabilizing, that in fact the downside risks reemerge, or the data just get worse, we'd have to look at both of those. We have a two-sided mandate.
If I could, if President Trump does pick a new Fed chairman before May, what does that look like? How would you work with that person, and what does that transition period look like?
I don't have anything for you on that. That will depend on Congress's actions and things I can't speculate on.
Howard Schneider with Reuters. Thank you for taking our questions. Given the changes in the statement and all you've said so far, is it fair to describe risks to both sides of the mandate as roughly balanced right now? And is the next move necessarily down?
I'd say that the upside risks to inflation and the downside risks to employment have diminished, but they still exist. So there's still some tension between the mandates. Are they fully in balance? Hard to say. And we think our policy's in a good place. I just discussed reasons why we might change our policy, and we'll just have to see how the data lead us.
I'm wondering, a minute ago you said you felt expectations were consistent with your mandate, that the 2 and the 10-year break-evens have moved quite notably in the last couple of weeks, I believe. Is there any concern on that front?
I mean, I recently looked at all of the both survey and market-based short-term inflation expectations have come way down. They were in a good place at the beginning of last year. They spiked around Liberation Day, and now they've fully retraced in the last few months. So that's very comforting. And the longer-term inflation expectations have remained in places that are very consistent with 2% inflation over time. So expectations have been solid, and they reflect confidence in the return to 2% inflation.
Andrew.
Apologies if this is a little bit repetitive, but in the past you've said that the reason you cut rates was that the risk to the labor market was greater than the risk to the inflation side. Is that still true?
We haven't made. You're right. We saw the labor market weakening, and we acted. And I think that was the appropriate thing to do. We will always act to address what we see as the economy moving away from our goals. Risks to both of the variables are a little less. I think that the upside risk to inflation, again, a little bit less, and the downside risk to employment, a little less. I just would say that I'm not making a judgment about how one of them is more at risk than the other, just that the risks to both of them have diminished.
Okay, thanks. BIS wrote a paper last summer which concluded that global investors were hedging their dollar exposures in ways that previously they hadn't because of policy uncertainty. Do you agree with BIS?
We really don't see much at all about that whole story. There's just not a lot of data that suggests that there's much to that.
Thanks.
Anna Swanson with the New York Times. Can you talk more about what you would need to see in the labor market to conclude it's time to resume easing? Do you need to see further deterioration in the labor market, or would it be enough for inflation to soften?
So we'll always be looking at both things. And so there could be combinations, infinite numbers of combinations that would cause us to want to move. Certainly, a weakening labor market would be an argument for loosening. But what's happening with inflation? If inflation were at the same time getting worse, you just have a very difficult situation there. So we'll be looking at both. Clearly, a weakening labor market calls for cutting. A stronger labor market says that the rates are in a good place. We'll have to be making similar judgments too on inflation.
And if inflation does pick back up and the labor market doesn't show further signs of deterioration, is there a chance that you could raise rates rather than simply remaining on hold? What would you need to see to consider hiking?
We don't take things off the table, but it isn't anybody's base case right now. Anybody's base case that the next move will be a rate hike. But ultimately we'll do what we think is the right thing. But that's not where people's expectations are right now.
Victoria. Hi, Victoria Guida with Politico. I wanted to ask, you've talked in the past about concerns about the U.S. fiscal trajectory, and we've seen in the Japanese bond market a lot of turmoil recently, in part due to concerns over their fiscal and long-term economic outlook. So do you worry that the U.S. could at some point find itself in a similar situation to Japan, whether for fiscal or demographic reasons?
Over time, you've seen that U.S. rates have remained they haven't moved a lot really for a while, but they haven't moved a lot because of what's been happening in Japan. So it's more of an over time thing. The U.S. federal budget deficit is, uncontroversially on an unsustainable path. The level of debt is not unsustainable. It's very much sustainable, but the path is unsustainable. And the sooner we work on it, the better. But, right now we're running a very large deficit at essentially full employment. And so the fiscal picture needs to be addressed, and it's not really being addressed. So that's important. I'm not in any way connecting it to some sort of near-term market event, but ultimately it's something we'll have to deal with. And that in the end game, that's where you wind up, is in some kind of a difficult thing. But that's not where we are. It's not what Japan is either. But it's certainly not where we are right now.
Does it reduce the effect of your rate cuts that longer-term rates have overall not really budged that much?
I wouldn't say that. The thing is, technically, higher longer-term rates means less accommodative financial conditions. But remember, many things move longer-term rates. It's not mostly what happens on the short end. There can be effects of longer-term rates from moving our policy around, but it's much more assessments of the fiscal path and fiscal policies and risks and things like that move the 10-year around. You can look back at and find periods where we've been very actively moving the policy rate over the course of a year, and over the course of that year, the 10-year is exactly where it started. So there's not a tight link between 10-year rates and the overnight rate.
Elizabeth. Thanks so much, Elizabeth Schulze with ABC News. Republican Senator Tom Tillis, who sits on the Senate Banking Committee, said he will block any Fed nominee, including the chair, until this investigation into you is resolved. Do you support this move by the senator, and what conversations have you had with the senator?
I've got nothing for you on that.
More broadly, what would happen to American households if the Federal Reserve loses its ability to operate independent from politics?
So really, the point of independence is not to protect policymakers or anything like that. It just is that every advanced economy democracy in the world has come around to this common practice. It's just an institutional arrangement that has served the people well, and that is to have a separation between to not have direct elected official control over the setting of monetary policy. And the reason is that monetary policy can be used, through an election cycle to affect the economy in a way that will be politically worthwhile. So I'm not talking about the U.S. context. This is every advanced economy democracy of any size. So it's a good practice. It's pretty much everywhere among countries that look at all like the United States. And I think if you lose that, it's, first of all, it will be hard to restore the credibility of the institution. If people lose their faith that we're making decisions, only on the basis of our assessment of what's best for everyone, for the wide public, rather than trying to benefit one group or another. If you lose that, it's going to be hard to retain it. And we haven't lost it. I don't believe we will. I certainly hope we won't. but it's very important. And the reason it's important is that it's enabled central banks generally not to be perfect, but to serve the public well.
You're confident it can maintain that independence at this point?
Yes. I mean, I'm strongly committed to that, and so are my colleagues.
Archie Orton, The Economist. On that sort of stabilization of the labour market question, how much do you see the weakening we saw in the past 6 months, year, as a kind of data mirage around immigration, the government shutdown, and so on, that's now resolved? Or how much have we seen a kind of real underlying firming up in the state of the labour market, do you think?
Well, part of it is, to your point, part of it just is that labor supply, growth in labor supply has come to essentially a halt from a fairly fast clip of growth over the last couple of years, driven by immigration, and then the halt being driven by a very sudden stop in immigration. So many outcomes were possible with that. Supply came way down. It turns out that demand for labor also came down a very similar amount, maybe just a little bit more, which is why the unemployment rate has gone up. So I don't know whether that's a coincidence or not, but that's what's happened with that part. But if you look at other things, like, for example, just to pick a couple, the Conference Board's measure of job availability that came out, I don't know, was it yesterday or today? But it shows, it's a survey showing that workers feel like job availability it's a very low reading. It's just one reading, but it's an indication of softening. People part-time for economic reasons, which is a category within the broader U6 category measure, has moved up significantly. So there are lots of, I could go on and on. There are lots of little places that suggest that the labor market has softened. But you're right. Part of payroll job softening is that both the supply and demand for labor has come down. Growth in those two have come down. So that makes it a difficult time to read the labor market. So imagine they both came down a lot to the point where there is no job growth. Is that full employment? In a sense, it is. If demand and supply are in balance, that you could say that's full employment. At the same time, do we really feel like that's a maximum employment economy? It's very challenging and quite unusual situation.
Thanks. And then one more on growth and the kind of strong growth outlook or strengthening growth outlook you're now seeing. How much of that is the fiscal stimulus we're seeing from the beautiful bill, the tax cuts, and all of that?
So you're seeing it already. Yeah, you don't have much of the fiscal. I think the outlook, you're right. It's financial conditions and it's fiscal policy for 26. But you've got strong consumption that's been happening before financial conditions have been supported, but before the fiscal effects really are shown. So essentially, the economy has once again surprised us with its strength, not for the first time. And consumer spending, although it's uneven across income categories, but consumer spending overall numbers are good, and we're benefiting from the AI build out of data centers. That's another thing we're benefiting from, but the economy overall, growth is on a solid footing. It looks like, and it's not just those things. It's just the consumer is filling out surveys that sound really negative, and then spending. So there's been a disconnect for some time between downbeat surveys and reasonably good spending data.
Thanks, Chair Powell. Christine Romans from NBC News. You talked about how consumer spending is uneven. The president calls inflation defeated and solved. The FOMC says it's a somewhat elevated inflation. But you talked about those customer survey or those consumer sentiment surveys and public opinion polls that show that most families say the cost of living is still issue number one. What is the conversation around the table with your colleagues about how wealthier consumers seem to be driving so much of the economy and why so many families still feel like they just can't make ends meet after 5 years of rising prices? What is that discussion like?
So a couple things. One, there's something to it in that we know that higher income households that tend to own real estate and tend to own stocks, securities, and those assets have been going up in value, and increases in wealth do support spending over time. So and that's clearly a part of the story. We also know that for some time now, for a year or more, we've been hearing from retailers, for example, that serve lower income customers, whether it be food or the big box stores or anything. They're saying the same thing, which is our consumers are looking to economize. They're trading down from brands and they're buying less, and it's changing their buying habits and that kind of thing. So we're seeing that, and that is a reality of what we're seeing. They're still consuming, but they're feeling it in a different way. I would say more broadly on affordability, we have a vast network through the reserve banks and also through the board of governors where we talk to small and large businesses and households, and so we do hear a lot about affordability, and we take that very seriously, and we take it to heart because one of our jobs is price stability. And so, the best thing we can do for people who are feeling that squeeze is to keep inflation under control and, frankly, to finish the job of getting inflation back down to 2%.
You mentioned the AI build out as being a positive for economic growth this year. I wonder, as you look at the weakest year last year for job creation of a non-recession year since like 2003, are you concerned about AI maybe supplanting more entry-level work and entry-level jobs, and how does that play into what you're watching about the labor market?
So everyone, of course, is watching AI and the deployment and, trying to understand exactly what's happening. And there's a wide range of possibilities. It's hard to say. And of course, anyone who uses it is amazed at what it can accomplish, right? So every technological wave will eliminate some jobs and create other jobs. And it's always been the case. If you look back, wave after wave after wave, there will be some disruption, but ultimately technology increases productivity, which is a basis for rising wages. And it may not all happen immediately, but over time, it's what enables incomes to rise over time is rising productivity. So and we always ask, well, this is going to be different, is it going to be different? And we don't know. And we may, in any case, see in the short term jobs that are being eliminated by the capabilities of AI. We may see that. We just don't know what the overall effect is going to be. So how to think about it in terms of macroeconomic terms, it's very hard. We can look at the aggregate data. We can analyze, for example, there is some connection, it appears, between the low hiring rate for recent college grads and AI, but it's not the main or only driver. You hear large companies, though, many of them saying that they either won't be hiring for some time, or that they're hiring less, or that they're laying people off, and they tend to refer to AI when they do that. So we're all watching and learning, and it could certainly have pretty significant effects on the economy, the workforce, and our society. We don't really have the tools to address the concerns that may arise, but we have a lot of people who focus on analyzing it and try to understand what the macroeconomic implications are, which is our job.
Thank you. Thank you, Chair Powell. Bayi from AFP News Agency. You mentioned earlier that on inflation, the broad expectation was for a one-time price increase and then for inflation to come down. And I was wondering, is your expectation still for inflation to start cooling in the second half of 2026? And if you could elaborate how far we are from target currently. Thank you.
So how far we are from target is, as I mentioned in my opening remarks, we had 3%, 3.0% core PCE inflation over the 12 months ending in December, and that's pretty much what we had the year before. So on net, no progress, but the story behind that is modestly positive in that most of the overshoot was in goods prices, which we think is related to tariffs, and ultimately we think those will not result in inflation as opposed to a one-time price increase. Okay, so that's where it is. In terms of, you asked, no one thinks they will, ex ante understand really clearly, precisely when this will happen. But there's an expectation that sometime in the middle quarters of the year, we'll see tariff inflation topping out. So what we do is when a tariff is put in place, we track the effect of those tariffs over a 6, 7, 8, 9 month period, and you can see for that tariff how long it takes to reach a place where it's affected the price level, and that's it. So we're getting better at that, and our estimate is that it'll be sometime in the middle of the year, but I wouldn't look for great precision in that. But we'll be able to see whether things are moving in that direction. I think we'll be able to see.
Richard, Escobedo.
Thanks, Chair Powell. I'm Richard Escobedo with CBS News. I want to look outside the U.S. about what's happening outside our shores and how it impacts the U.S. Canada's Prime Minister said last week that there's been a rupture in the global order, and I wonder how you're thinking about geopolitical risk as it relates to the U.S. economy.
So I can't comment on that speech or statement or anything like that. Geopolitical risk for us is a lot of it is around energy, oil. And so far, we haven't, for all the turmoil, oil prices have come down, as you know, and so we don't really see much. Longer than that, it's trade, and the trade, our economy has pulled through pretty well. You'd have to say, given the very significant changes in trade policy, the U.S. economy has pushed right through. Partly that is that the way that what was implemented was significantly less than what was announced at the beginning. In addition, other countries didn't retaliate, and in addition, a good part of it hasn't been passed through to consumers yet. It's being taken by companies that stand between the consumer and the exporter. So that's where that is.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. With third quarter GDP growing at 4.4%, and when you had a government shutdown and we thought that was going to shave off some growth, you've also got the fiscal tailwinds you've talked about, big tax refunds coming, potential tariff dividend. How could you cut rates and not spur inflation in that environment?
Well, we didn't cut rates today, but it depends on how fast potential output is growing, right? I'm just asking in principle. I'm not saying this is what's happening, but there's growth and there's how fast the potential is growing. And at a time of high productivity growth, potential output is rising. So it really matters whether potential output is growing as fast as actual output, and it would matter over time. The numbers you cite were for quarters, and quarterly GDP is you need to look at 12 months because quarterly GDP can be very lumpy. GDP was negative in the first quarter last year, so the overall over the year the numbers were nothing like that. It was more in the mid twos for the year.
And how do you explain the divide right now between strong economic growth and the job market? Is it productivity that's filling the gap? And is productivity being driven by AI at this point?
So you're right, there has been a divide of solid growth, but what looked like a weakening labor market. And that can be explained by rising productivity. But I would say we do see signs of certainly of the unemployment rate stabilizing. So it may be we're seeing the beginning of the resolution of those two things. Also, as you probably know, the lore is that when GDP and the labor market get into an argument, in the end, the labor market data is more reliable. GDP data is just very hard to collect and understand, but nonetheless, I think we may be seeing that tension resolving a little bit. Too soon to say with any confidence, though.
Matt Egan with CNN. Chair Powell, after today, you have 2 meetings left as Fed chair. You've obviously experienced a lot during your time as Fed chair, served under multiple presidents. I'm wondering what advice you have for whoever your successor might be.
Honestly, I'd say a couple of things. One is, stay out of elected politics. Don't get pulled into elected politics. Don't do it. And that's another thing. Another is that our window into democratic accountability is Congress, and it's not a passive burden for us to go to Congress and talk to people. It's an affirmative, regular obligation. If you want democratic legitimacy, you earn it by your interactions with our elected overseers. And so it's something you need to work hard at, and I have worked hard at it. So, and the last thing is, it's easy to criticize government institutions so many ways. I will tell whoever it is, you're about to meet the most qualified group of people you not only have ever worked with, you will ever work with. And when you meet Fed staff, and not everybody's perfect, but there isn't a better cadre of professionals more dedicated to the public well-being than work at the Fed.
Thanks for that answer. If I may follow up, as I'm sure you've noticed, gold and silver prices have experienced historic gains of late. And I'm wondering how much attention, if any, you pay to those moves and what message you may take from these significant price increases we've seen for precious metals.
Don't take much message macroeconomically. The argument can be made that we're losing credibility or something. It's simply not the case. If you look at where inflation expectations are, our credibility is right where it needs to be. So we look at those things. We don't get spun up over particular asset price changes, although we do monitor them, of course.
Nicole, for the last question.
Hi, Nicole Goodkind-Barons. Some prominent critics have charged that the Fed's economic models are somewhat backward-looking, but should be more forward-looking, incorporating things like productivity increases from AI. How do you incorporate current and future developments into your analysis and decision-making, and do you have an answer to those critics?
Yeah, so by and large, those criticisms, as somebody on the inside, they just don't make sense, and I'll tell you why. Every FOMC participant writes down a forecast every quarter, right? The summary of economic projections, and that's the basis for how we think about the economy. So, and the other thing is, what an economic model can do is it can grind up all the data for the last number of years, 50 years, let's say, and it can identify what are the relationships between variables A, B, C, D, and all that kind of thing. And it can tell you if you change one of those variables, this is what should happen in the macroeconomy. That's just the way it works. However, the structure of the macroeconomy is constantly changing. For example, we hadn't had a pandemic in 100 years. It wasn't in the model, and we knew it from the very beginning. It was not in the model. A trade war of this scope, we've never had that in 100 years. And so there's great uncertainty at different points. Another thing I'll say is, when it comes to, technological developments that raise potential output, some kind of technological revolution, like happened in the 90s here, and like maybe happening now with AI, we're all over that. And everyone studies those periods, and we're very clear-eyed about the possibility that this higher productivity may persist. And also that it may not. We're not. No one's sitting here unaware of the possibility of higher productivity. We've been talking about it for 3 years. It long predates the current situation. It's been going on for 5 or 6 years. We've had productivity higher. We've been talking about it that whole time. So it's very much on our minds, and we are well aware that higher productivity means higher potential output, and it changes the way you think about potentially inflation, growth, labor market, and all those things. That's all in our models. I mean, if it's just a question of using better models, bring them on. Where are they? We'll take them. But I think, we certainly are in contact with anybody who does economic modeling, and we're always looking to do better at that. But that's how I think about that.
And just a quick follow-up. We've been talking a lot about tariffs and passing through, and we've been talking a lot about them for the past few months. The trade landscape is still in a constant state of flux. Announcements, threats, negotiations are all frequently changing. So I'm wondering how you actually track these, what data or channels are most critical to follow this in real time.
Trade?
Yeah, the impact of tariffs and how they're changing.
Yeah, I think our staff has done a really nice job on that, and they kind of put it together in real time. So as I mentioned, a tariff gets put in place, you can pretty much track its effects on pricing and on everything. And so you build a model up from all of the tariffs, At the beginning, it was very much of a forecast. Now it's every cycle that goes by, it becomes more informed by actual data. And our forecasts were not far off. What changed was, as I think I said earlier, what changed was what was implemented was smaller than what was announced. In addition, we didn't see retaliation internationally, and I think people did generally expect that because we saw that in the past, and that really mattered too. And then the other thing is that pass-through didn't know how fast that was going to be to consumers, didn't know how much exporters would take, how much companies in the middle would take, and how much the consumer would take. And it turns out it's a lot of companies in the middle who, by the way, are pretty strongly committed to passing the rest of it through, which is one of the reasons why we need to keep our eye on inflation and not declare victory prematurely.
Thank you.
We're done?
We're done.
Okay. Thank you very much.
Okay, all finished up. Very, very slow FOMC, that's for sure. I mean, higher time frames, no change, no engulfing down, no break of structure. Nothing is actually really changed on the higher time frames. And there's a potential that everything is in a wave C on the weekly, so just keep that in mind if you're, more of a high time frame trader, especially that we could be in the middle of a wave 3 on the weekly on the Aussie dollar, which would probably put us up a lot further than we are. If we're really in a wave 3, this thing has a long ways to go. US dollar CAD, this could be potentially a wave 1, wave 2, wave 3 also. Pound dollar, pound dollar. But yeah, I'm actually long the pound dollar. I took a little bit of a long on it, but I'm not going to hold overnight if it doesn't go up. I'm really just looking to take profit here. I was thinking we were going to get that wave 3, 4, and 5 shape. If you zoom out on the dollar pairs on around the 1 hour time frame, or maybe go up to the 2 to 4 hour time frame, you can see a very clear 1, 2, 3. Now, maybe the time factor hasn't been fulfilled yet because this pullback is pretty decent size compared to this pullback. This one might be a little bit longer. So maybe it's going to stretch out a little bit more before it goes up. But I think the pound dollar needs to make that 345. Is just whether or not it needs to stretch out into something like this before it goes up, or whether it's going up now. I did go long at the 50% level, still holding, but I definitely won't hold overnight if it doesn't go up. Euro dollar did make a pretty strong push down today, but there's still no break of structure at all. This move down does kind of lead you to think that it potentially is like a wave A, and maybe it ends up doing something like this for the next 24 hours or so, do like a double bottom at the 61 or 78%. The Aussie dollar, like I said, Aussie dollar is one of the strongest ones right now. If it breaks structure at a Fibonacci level, then fine, we'll become bearish, but we could be in the middle of wave 3 on literally everything. And if we are in the middle of wave 3 on everything, then we have a lot of upside potential on everything. US dollar CAD, if it breaks this high right here, we're going to know that this wave right here is complete. So we would potentially, watch our Fibonacci levels for more shorts maybe over the next 24 hours if that does happen. US dollar Swiss, same type of thing. If it breaks structure to the upside, fine. We'll definitely be happy to become bearish. But the move up does look impulsive on many of these pairs. Like it's like a wave A, and it's going to do something like this over the next 24 hours, make like an overlapping pattern while people decide whether they think the market is bullish or bearish. And gold, we're getting very close to that Fibonacci level that I just showed you. The 61% of the last wave is at price 5,345, 5,349 maybe. So we're very close to that level. And if gold hits a Fibonacci level and then breaks structure to the downside, then maybe we will have a bigger wave down. But keep in mind that the break of this structure only proves that the last 5 waves is complete. It could break this low, spend a couple days in a pullback, which would be a pullback to this last wave, and then continue up if it wants to. Definitely with those 5 waves right there, it does seem like it'd be pretty likely for a more proper, pullback. Gold does like to make expanding and running pullbacks, so definitely keep in mind that the wave B could even make a new higher high. So definitely still very bullish on gold. Does look like a 5-way pullback is due, but that's the kind of thinking that could get you in a lot of trouble. So anyways, I'm gonna do my PM videos here in a few minutes. So that way, the PM videos are either for my YouTube members or my premium members on my website. Like I said, my website is very, very cheap. It's only $30 a month. It's fxpipcollector.com. Definitely check it out. And I do share every single trade I take with my members at the time of entry. And I'm doing an experiment right now with the Kelly criterion formula where I'm trying to turn 1,000 euros into 10,000 euros. And my theory is if I can do that, then I should be able to turn 10,000 euros into 100,000 euros because that's the exact same math as turning 1,000 into 10,000 using the Kelly criteria formula. So, anyways, I hope everybody has a great night. Definitely like and subscribe so you don't miss out on my live streams that I do every Wednesday. And I do a morning market breakdown every single morning, covering these list of pairs right here, the dollar pairs, including gold, dollar yen, euro yen, and the pound dollar. I do that every morning. And then every 4 nights a week, Monday, Tuesday, Wednesday, Thursday, Friday, I do a PM video for the euro dollar, gold, uh, euro dollar, pound dollar, gold, and the US dollar yen. And those videos are only available for people that join my membership on YouTube or people that join my premium membership as an extra benefit to them. So, anyways, I hope everybody has a great evening. Good luck to everybody, and as always, thank you for watching and happy trading to everyone.